Debt management and repayment. The importance of debt management should be emphasized very clearly. The Treasury Department is in charge of debt management on two fronts. The one function is to carry out debt operations necessitated by a current budget deficit or surplus, including an increase or decrease in overall debt. If the budget is balanced for the whole fiscal year, the flow of tax revenues and expenses is not coordinated monthly, necessitating intermediate debt funding. Another function, and one that is far more significant in terms of volume, is large-scale refunding operations. They must be carried out when maturing debt instruments are replaced by new problems with different maturities and other characteristics. This activity is carried out by the Treasury's Debt Management Division with the support from the Federal Reserve Bank of New York in the case of US. The debt management is mostly an executive role and does not require active legislative involvement. However, Congress also imposed certain limitations on debt managers, such as an interest ceiling and prohibition on issuing debt commitments at a price less than their maturity value. Besides, Congress sets a limit on the overall amount of debt that the Treasury will incur. Furthermore, though spending has been already approved by congressional law, the Congress uses this cap as an extra tool to regulate the number of expenses. Even if debt management in the broadest sense is an executive obligation, the conditions on which debt can be put are heavily influenced by the fiscal reserve system's monetary policy. As a result, the Board of Governors is a significant and equitable partner to the Treasurer in handling the national debt. There are many debt instruments available in an economy. The debt instruments are issued for a fixed amount of time with the capital paid in full at the maturity date. While perpetual bonds have been used in British finance history, the US Treasury has never issued them. The debt's maturity structure was considerably reduced during the 1950s and 1960s, whereas in the 1950s, long-term debt of more than 20 years accounted for 16% of overall debt, and the debt of less than 1 year accounted for 27%, and the core ratios in 1970 were 5% and 14% respectively. The total number of years to maturity declined from 8.2 to 3.7 years, and the debt management in the 1950s and 1960s, they resulted in a significant change towards the greater debt liquidity and increased the average volume of refunding. This shortening trend was eliminated in the 1970s and has been partially reversed since the 1980s. Despite this activity, the most debt that we see in an economy, especially in the US, they remain highly concentrated at the short end, with maturities of more than 10 years accounting for just 16% of the amount. The Treasury's reliance on short-term debt during an inflationary period has allowed it to postpone long-term commitments to borrowing at high nominal rates of interest, especially when we are expecting that inflation will be contained and the interest rate will decline in the future. Simultaneously, investors are concerned about the future, whether the inflation can worsen or not, and they tend to postpone long-term commitments. As a result, it is more convenient to refund maturing problems on a short-term basis, but doing so will increase the framework's liquidity. Debt repayment. Repayment is the act of repaying money that we have borrowed from a person or an organization as a loan. Typically, assets are returned by annual installments that include both principal and interest amount. The term principal refers to the initial amount of money lent as a loan, and interest is the fee for the benefit of borrowing the money. and a borrower must pay interest to access the funds released to them by the loan. The loans may usually be paid off in full at any time, but there are some contracts which imposes an early payoff charge as well. Since the budget and the economy are very constant endeavors, the national debt does not need to be repaid. Once a given debt concern matures, it is paid off. Nevertheless, the funds needed are collected by issuing a new commitment or new commitments. The loan has been refunded according to them. With the debt being still short term, the annual refunding volume is currently about $2,500 billion, with maturing debts being paid and replaced by refunding problems weekly. Whereas in the past, refunding operations were highly complex, especially it involves the accurate calculation of market yields, techniques which are introduced in recent years. These calculation of market yields and several techniques and technology have significantly simplified the financial matters when it comes to debt management and repayment. New issues are now sold by an auction scheme where we have dealers sending close bids and that are faced on a first come, first saved basis. This trend has been aided by a greater dependence on short-term loans offered at a discount rather than a coupon. The Federal Reserve Bank of New York in the US, which is nearest to the monetary market or money market, deals closely with the Treasury and functions as its representative to expedite the refunding process. In brief, the refunding activities are a management concern, and the question of whether we should repay the debt is very much misdirected. So the real question is how the interest service will impact the economy and how the unpaid debt will join the economy's liquidity system.